In late February, a military escalation in the Middle East disrupted the stability of global fixed income markets. This conflict resulted in a de facto military blockade of the Strait of Hormuz. By closing this maritime corridor, the blockade created a prolonged constraint on the global energy supply. The bond market is signaling that this energy shock now outweighs concerns about domestic economic growth. The blockade has frozen the Federal Reserve's policy options, increased the cost of holding long-term debt, and created a specific refinancing risk for corporations. Global energy constraints have replaced economic stagnation as the primary driver of market behavior. To understand the shift, we look at this baseline, the U.S. Treasury yield curve as it appeared in January. After the blockade began, yields on 2- to 5-year bonds spiked, creating a significant flattening of the curve. This spike in medium-term yields is the direct result of rising inflation expectations. It reflects a market that is no longer pricing in interest rate cuts for the near future. This section of the curve, the belly, is where the market is concentrating the impact of the energy supply constraint. This chart plots the break-even inflation rate, or BEI, a market-based measure of expected inflation derived from Treasury yields. The data shows a sharp rise in inflation expectations for the next 5 years. However, expectations for the 10-year mark and beyond remain flat. The shape of this curve indicates that the market views the inflation threat as a specific medium-term event. Institutional buyers believe the energy shock will be severe. They are positioning for a crisis that hits its peak over the next few years, rather than a permanent shift in long-term inflation. The inflation-linked bond market confirms that the shock is an immediate concern for capital allocators. We see this shift clearly in the overnight index swaps, or OIS, curve, a derivative tracking the Fed's target rate. The left side shows pre-blockade expectations of a steady rate decline. The right side shows the current curve, inverted into an upward trend. This change indicates that the market has abandoned its expectations for an upcoming easing cycle. The prior consensus was a return to a neutral policy rate of 3. With structural uncertainty surrounding future inflation, investors require higher compensation for holding long-term debt. This extra compensation, known as the term premium, is expected to expand. This expansion will lead to higher yields on 10-year, 20-year, and 30-year government bonds. The 10-year U.S. Treasury yield recently reached 4.27%, signaling the start of this shift. While the initial shock was priced into the 5-year timeline, expanding ultra-long-term premiums remain the central risk at the long end of the curve. This dashboard shows a typical corporate debt maturity schedule, where each bar represents a year when debt must be repaid or refinanced. Debt maturing in 2026 and 2027 represents a specific hazard. Refinancing costs for these years are priced based on the 2- to 5-year section of the Treasury curve, which has already spiked. This leads to a direct increase in the firm's weighted average cost of capital, or WACC, the average rate a company pays to finance its assets through both debt and equity. CFOs cannot wait for yields to retreat before these maturity dates arrive. Managing these liabilities must become a priority. Corporations should consider selling non-core assets or using private credit to restructure their debt today. Failing to restructure these 2026 and 2027 tranches today will lock the enterprise into elevated debt servicing costs for years to come. For institutional allocators, holding these long-duration government bonds now carries significant risk. Higher term premiums lower the value of existing long-term bonds, as seen during the recent spike in the 10-year yield. This diagram shows the shift toward safety, moving capital out of long-term bonds and into 0- to 3-month Treasury ETFs. These short-term vehicles provide current income while protecting the principal from interest rate changes. Short-duration investments allow portfolios to capture yield while avoiding the risk associated with a volatile long end of the curve. Higher Treasury yields and the geopolitical shock have caused investors to move into the U.S. dollar. This strength creates friction in corresponding banking, the network banks use to provide services for one another across borders. This friction leads to delays in settling cross-border transactions when traditional financial systems are under stress. Consequently, corporate treasuries are diversifying the way they move and hold liquidity. This diagram illustrates the shift toward U.S. dollar-backed stablecoins. These are digital assets pegged to dollar that operate on blockchain networks, allowing for a direct route for capital. These assets provide dollar stability while allowing for instantaneous 24/7 cross-border settlements. Utilizing these modern digital liquidity rails is a defensive operational strategy for CFOs navigating this era of global market paralysis.